Ever watch a game, maybe football, and see a player feint one way just to go the other and get an edge?
Yeah, that kind of misdirection play.
Exactly. Well, financial markets have their own versions. Today, we're doing a deep dive into two of them, spoofing and layering.
Right. And these aren't just, obscure terms for traders. They really hit at the core of whether markets are fair for everyone involved. It's about transparency.
Absolutely. Because, look, whether you're saving for retirement or you're just trying to figure out what the market's doing from the news, understanding these tricks gives you a bit of insight, a peek behind the curtain, maybe.
Uh-huh. Shows you why we need the rules, why we need the refs on the field, so to speak.
Good analogy. So let's get into it. Spoofing first. It's about creating a false impression, isn't it?
Precisely. Yeah. A trader puts in a big order, say, to buy or sell something. But here's the kicker. They have absolutely no intention of letting that order actually go through.
No intention.
None. It's purely to create this uh, fleeting illusion, like there's suddenly huge demand or maybe huge selling pressure.
Yeah.
It's like starting a rumor just to see who reacts.
Okay, let's unpack this a bit. So maybe a trader puts in a massive order to buy, I don't know, thousands of shares of some stock.
Right.
And anyone watching the market data feed sees this pop up and thinks, whoa, okay, something's happening here. Big buyer, price must be going up. Maybe I should jump in now.
That's exactly the psychology they're playing on. They want to trick others into thinking there's real upward momentum.
Okay.
So once that false demand pushes the price up, even just a tiny bit,
Yeah.
the spoofer quickly sells the shares they actually own at that slightly higher price, and then, poof,
Yeah.
that an initial huge buy order they put in
Gone.
vanishes, canceled, like it was never really there.
Wow. Okay, so it's a really quick in and out manipulation, mislead people, make a quick profit. And you mentioned this is especially a thing in high frequency trading. Why there?
Ah, yeah, because in HFT, you've got algorithms making decisions in, like, milliseconds,
Right.
way faster than a human can react.
Right.
So these fake signals, even if they only last for a fraction of a second, can be enough to trigger those automated systems to buy or sell.
I see.
And that creates these tiny price differences that the scoofer can exploit. Now, maybe it's just fractions of a cent per share on one trade,
Doesn't sound like much.
but when you do it over and over really fast across huge volumes, it adds up big time. We're talking potentially millions.
Yeah.
That's the real danger.
Right, so spoofing is like a digital magic trick, an illusion in the data stream to make a quick, maybe not so honest, buck. Now, layering, you said that builds on spoofing, sounds more complicated.
It is. Layering is definitely a more sophisticated and often trickier to spot version of spoofing.
Okay.
Instead of just one big fake order, the manipulator places multiple orders, usually non-genuine ones. Yeah, at different price levels, often just slightly away from where the market is currently trading. Think of it like building a fake wall of buy-or-sell interest in the order book.
A fake wall.
Yeah.
Okay, that paints a picture. So not just one big flare, but lots of little signals stacked up.
Exactly. Stacked up to make it look like there's real depth, real conviction in the market.
Ah, reinforcing the illusion.
Precisely. If they want the price to go up, they build layers of fake buy orders just below the market price, making it seem like there's strong support. If they want it down, they layer fake sell orders just above.
And does that work? Does it fool people?
It can, yeah.
Yeah.
It makes the fake sentiment seem more robust, more real. It can definitely entice other traders, especially algorithms, to react to what looks like genuine market pressure.
And I'm guessing these layers don't stick around for long either.
Oh, not at all. We're talking milliseconds again, placed and canceled almost instantly. Usually orchestrated by complex algorithms, HFT systems. It's incredibly hard for a human trader to even see it happening, let alone figure out what's real and what's fake,
Yeah.
like watching a card trick on fast forward.
So technology is both the tool for trading and the tool for this kind of deception.
Wow.
And you also mentioned that they might place real orders alongside these fake layers. How does that fit in?
Yeah, that's often the final piece of the puzzle. While they're building these fake layers on one side, say fake buy orders,
Uh-huh.
they might place a genuine order to sell on the other side. The fake layers induce a small price move in their favor. Maybe the price ticks up slightly.
Right.
Then they execute their genuine sell order at that better price, make their profit, and then instantly cancel all the fake buy layers.
It sounds incredibly calculated, like a very high-stakes digital con game.
It is, which is why, unsurprisingly, regulators are all over this.
Right. So let's talk about that. This stuff is illegal, presumably.
Oh, absolutely. Spoofing and layering are strictly prohibited. Market abuse, pure and simple. In the U.S., you've got the CFTC, the Commodity Futures Trading Commission, and the SEC, the Securities and Exchange Commission, policing this.
And elsewhere.
Same deal. In the UK, it's the Financial Conduct Authority, the FCA. Major jurisdictions globally have rules against this kind of manipulation.
And the consequences if you get caught, not just the slap on the wrist, I imagine.
Definitely not. Fines can be huge, millions, sometimes hundreds of millions, even billions in some major cases.
Wow.
Regulators can also force them to give back any illegal profits, ban them from trading, and yeah, in serious cases, individuals can face criminal charges, jail time. They see it as a fundamental attack on market integrity.
You mentioned the flash crash back in 2010. That was a big deal.
Yeah.
How did spoofing or layering play into that? Or did it highlight the risks?
It really highlighted the risks, yeah. The flash crash was complex, lots of factors involved. But investigations afterwards did point to some aggressive order book activity, including large orders being placed and canceled very rapidly, that likely contributed to that sudden, massive drop and rebound.
So it showed how these tactics could destabilize things.
Yeah, exactly. It was a wake-up call. It showed how, in these super-fast, interconnected electronic markets, manipulative tactics, even by one or a few actors, could potentially trigger much wider instability. That really spurred efforts to improve surveillance.
Which brings us to detection. How on earth do regulators and the exchanges and firms themselves actually spot this? It sounds incredibly difficult given the speed.
It is difficult, but that's where technology comes in again, this time on the side of the good guys, regulatory technology or RegTech.
RegTech.
Yeah. Market surveillance platforms are key. These are sophisticated systems using real-time data analytics, pattern recognition, looking for suspicious activity.
Okay, so what kind of patterns set off alarm bells? What are these RegTech systems looking for?
Well, there are a few key red flags. One big one is a really high order-to-trade ratio,
Meaning?
meaning a trader is placing tons and tons of orders, but hardly any of them are actually resulting in trades. Lots of placing and canceling.
Ah, okay. Makes sense. What else?
Frequent cancellation of large orders, especially if those orders were placed way off the current market price orders that never looked likely to trade anyway.
Right.
And specifically for layering, they look for that signature pattern. Rapidly placing and canceling multiple orders at different price levels, just sitting there, creating that fake wall. And then, crucially, seeing if that activity is immediately followed by the trader executing a profitable trade on the opposite side of the market just before the layers disappear.
So it's about connecting the dots, seeing the fake setup and the profitable takedown happening together repeatedly.
Exactly. Spotting those non-economic, manipulative patterns that just don't look like normal, legitimate trading.
And what are firms like brokers or banks expected to do about this? They have to monitor for it too, right?
Yeah. Oh, absolutely. They're required to have robust systems in place. That means setting alert thresholds, having automated systems flag suspicious trades, keeping detailed audit trails of every single order placed, changed, canceled.
And if an alert goes off?
There needs to be a clear process. Investigation by compliance teams, and if it looks like real manipulation, they generally have an obligation to report it to the regulators.
It really does sound like a constant technological arms race, a cat and mouse game.
It is, to a large extent.
So let's zoom out. What's the bigger impact here? Why should someone, maybe listening now, who isn't a high-frequency trader, care about spoofing and layering?
Because it fundamentally damages the market's main job, price discovery.
Price discovery, you mean figuring out what something is actually worth?
Exactly. That process relies on genuine supply meeting genuine demand. When you have manipulators throwing fake orders around, it distorts that process. Prices might not reflect the true value anymore, even if only for moments.
And that matters because
it erodes trust. If investors feel the market is rigged, that prices are being manipulated, they lose confidence. They might be less willing to participate, less willing to invest their capital.
Yeah, that makes total sense. If the game feels unfair, why play?
Precisely. And beyond trust, it can just make markets more volatile, more jumpy, create instability.
Yeah.
As we saw with the flash crash example, these things can have knock-on effects in today's electronic markets.
So fighting spoofing and layering isn't just about catching a few bad actors. It's about protecting the health and fairness of the whole financial system.
Absolutely. It's crucial for maintaining that trust, which is really the bedrock of well-functioning global markets.
And it's an ongoing battle, as you said. Technology keeps evolving on both sides.
Constantly. The detection methods have to keep getting smarter to keep up with the ways people might try to game the system.
Well, this has been really fascinating and maybe a little bit sobering, actually. A real deep dive into spoofing and layering. So, just to recap for everyone listening, these are illegal manipulative tactics designed to create false impressions, move prices artificially, and allow the manipulator to profit.
Right. They're heavily scrutinized by regulators like the SEC, CFTC, FCA. Detection relies on sophisticated tech looking for those telltale patterns.
And ultimately, they're a threat to market integrity, to that trust we were talking about.
And hopefully, understanding a bit about how this works gives you, the listener, some valuable insight into just how complex financial markets are, but also the safeguards trying to keep them fair,
Yeah,
even if those safeguards need constant updating.
definitely. So, here's a final thought to leave you with. As trading gets even faster, more algorithmic, maybe even driven by AI, how do we keep adapting?
Good question.
How will regulators and firms stay ahead of potentially even more sophisticated manipulation tactics in the future? Could AI be part of the problem and part of the solution used to manipulate, but also to detect manipulation?
That's definitely the big question facing the industry and regulators going forward. It's something to watch. And, if you do want to dig deeper yourself,
Yeah.
try looking up some recent enforcement actions. Check the websites of the CFTC or the SEC or the FCA. Reading about real cases can really bring home how this stuff works in practice and what happens when people get caught.
Great suggestion. Real world examples always hit differently.